In addition to the qualitative analysis in the business plan, the next and very important step is a financial model. This needs to show the current financial status of the company, but also to communicate the key drivers for growth of the business and profitability of the business, and to clearly outline the expectations for the future of the business in terms of its financial performance. This is critical for driving analysis of both and demonstrating the capital needs, showing how you're planning to use the capital that you raise through this process, and then for being the basis for a valuation discussion with the investor. And these financial statements and financial model should certainly include historical financial information, as well as forecast financial information, ideally showing both showing the operations of the company and how that translates into both the profit and loss statement or income statement, a cash flow statement, and a balance sheet. It should also make clear the uses of the funds that you plan to raise, and should ideally be able to show sensitivities. And by sensitivities, I mean how the financial results will vary depending on certain changes in certain assumptions. As I mentioned before, a financial model needs to include all three of the typical financial statements. So a balance sheet, which is to say a snapshot of the assets and liabilities and equities of the company at a point in time. We need to show how that changes throughout the life of the company. An income statement, which shows the revenues, the costs, and the net income generated by the business during each financial period. And then finally, but last but not least, a cash flow statement, which shows how much cash you've generated, the company will generate in each financial period. I mentioned cash flow is critical. Ultimately, revenues are necessary, profits are nice, but what allows you to pay dividends, what determines whether you will have the capital needed to finance your operations, ultimately is cash flow. And so many investors, when they're thinking, particularly when they're thinking about valuation of a business, but also when they're thinking about capital needs of the business, will zero in immediately onto cash flow. But cash flow, it's not exactly the same as net income. Net income needs to be adjusted by adding back depreciation, which is a non-cash charge, backing out capital expenditures and cash spent on working capital in order to get from income to cash. We show on the slide another way of working down from EBITDA, which is earnings before interest, tax, depreciation, and amortization, working from that line also down to cash. There are various ways to get at it. Once you have cash flow, that is the key input for a discounted cash flow analysis that's often used to value a company. And as I mentioned before, it's very much a key measure of how much it allows you to really see how much cash you need to execute the plan that you have, and really to understand the ability, having a view of your cash needs, particularly in the short term, is also critical to just managing the liquidity of the company.